9 a.m. in Beijing and Hong Kong. Welcome to Bloomberg Markets China Open. I'm Yvonne Man. Our top stories this morning. Stocks retreat in Asia as Treasury yields and the dollar gain ahead of the Fed's key inflation metric that's due later on Thursday. Bitcoin, though, surpassing 60,000 as a surging demand from ETFs triggers a bull run. Also ahead, Chinese regulators telling quants to phase out a popular trading strategy that they blame for the market turmoil. And we speak to the CEO of budget carrier Hong Kong Express about the airline's growth strategy and how it's tackling supply issues. Jeanette Mao joining us in just a few minutes' time. In terms of the market action, what we're looking at, really, we're continuing to see what happens when it comes to China. That sell-off that we saw yesterday certainly was one that was quite swift and deep on, our initial reports about how the CSRC is going to be strengthening the regulation of these DMA or other derivatives. So that certainly is one to watch, particularly when it comes to those small caps. We'll take a look at that in just a bit. But A50 futures are lower this morning. S&P futures are also slightly to the downside here. We're watching what goes on with U.S. Treasuries, right? Because what we saw at 426 for that, are we in favor of some sort of rally that everyone's been kind of forecasting a few months ago? Bond steepeners alike here. Is that finally coming through? And we're still checking Bitcoin. 61,000. Gosh, we've blown past 60. Now we're at 61. Certainly, we're continue to see this explosive rally this year. I think it's still one of the best asset classes year to date so far, beating many out there. Take a look when it comes to equities here in the region. We're slightly on the back foot here today, with the exception of Singapore that's just coming online. You're seeing the Nikkei retreat just a bit here, but keep in mind we're still, talking about those all-time highs for that market to end this month, and Kospi as well as Taiwan. Taiwan coming back from that holiday, still seeing some declines here. And we're watching very closely what happens with treasuries when it comes to bond markets here. So really, you're seeing that being felt here in the Asia region. Bonds heading lower. Your Aussie 10 years at 412 right now. We heard from Fed officials just talking about, they are going to be data dependent. It's not about a calendar when it comes to the timing of rate cuts. And then we're watching China very closely, right? So we talked about the sell-off yesterday, which was quite brutal. First, there was kind of downside and disappointment with this Hong Kong budget, which certainly we saw property developers were the clear winners. But then again, this talk about a higher tax for high income holders here or earners here, that certainly did lead to some disappointment. The FX is doing this right now. We take a look at the dollar certainly trimming some of those gains here. You're still seeing some strength in the yen, 150.52. Kiwi dollar continues that decline after that dovish RBNZ statement that came out yesterday. Aussie dollar is flat. Dollar China is also flat. But yes, what's not flat is what's been going on in China. So it's been a good month. But yesterday, there was still some wobbles and concerns about what these new quant rules mean. Take a look at the CSI 2000. We were down close to 7%. The Golden Dragon Index was also lower by more than 1.5% yesterday. But mainland investors, southbound flows, watching that very closely. They actually bought Hong Kong stocks for 10 straight days. In terms of your agenda here today, so it's the new quant rules and what we're hearing from the CSRC, that's certainly in focus. We're expecting to hear more on the budget balance in Hong Kong, of course, after that unveiling of some of these support measures. Earnings coming through, the likes of Hong Kong Exchange, NetEase, New World you can add into that mix as well. We have some data coming out from Macau and hotel occupancy. And of course, crypto continues to be the dominant sort of theme this week here. Also seeing if we see still that rally when it comes to some of these developers here in the city. 61,000. Who would have thought we would reach that level just this week alone? For more on what to expect out of markets here today, let's bring in our MLI strategist, Mark Cranfield, joining us now. Mark, it seems like when it comes to Chinese stock traders, they were pretty spooked by some of these new regulations. What we're hearing from the CSRC. Just walk us through what this means, right, when they're limiting or at least cracking down on these DMAs.
Well, the problem for traders here is that some of the measures from the CFTC, such as this reducing of the quant activity, some of the other things they've talked about, reducing net selling in the first 30 minutes or the last 30 minutes of the trading day. On a long-term basis, they may be positive for China onshore equities and may help to stabilize the market. And it may eventually might bring some kind of stability that brings backing the long-term real money into China. The problem is in the short term, first of all, it reduces liquidity. The quant people put a lot of money into the market. They're probably going to have to reduce positions substantially. That will take some money out of the market. It also puts off a number of traders who don't like being told when they can trade, how they can trade, how much they can trade. Those kind of factors are not the kind of thing, particularly if you're in the hedge fund space. If you're the kind of people in that kind of investment flow, you can go to any part of the world. Most markets are open, they welcome your money. They don't have to tell you when you can come in and come out. So in the short term, some of these things are pretty damaging because it puts off some of the fast money that drives markets on a day-to-day basis. It may work longer term for China, but there are going to be plenty of disruptions between them. And for now, it's being taken as a slightly negative signal. It will take a few days for things to settle down. But the more you see interjections like this from the CFTC, initially, investors won't like it.
And that brings me to the MPC. Is there anything there in particular that could maybe, offset some of these concerns when it comes to these quant trading strategies?
There's a very high bar for the NDC to impress people, basically. Typically, it's a very big picture, high-level stuff. It all sounds nice on the surface, but the details are usually missing. They may surprise us. They may come up with some very concrete measures that people were not expecting. That has not been the track record of the MPC over the years. Usually, it just focuses on big plans, how to support the economy over a long-term view. That doesn't mean a great deal to financial markets in the short term. So yes, no doubt we'll see an engineered rally in stocks on the day the big announcements are being made, but it might not last if there's no bite to the announcements that come out. So from a market's point of view, MPC is not going to mean a whole lot to traders.
PC inflation's out in the U.S. That certainly is the next print to watch for bond markets. And obviously, expectations are that it's going to be a big and high number, just given just how hot that CPI print was just last week. I'm just wondering, is there less room for some sort of upside surprise in that way? And can we actually confirm in some ways that we've reached a peak in Treasury yields now, Mark?
Yeah, indeed. And it's also a big one for currency markets as well. So going into the data, markets are pretty much priced expecting a small increase on the month-on-month numbers, which is part of what the Fed watches very closely. So it won't be a huge surprise if we see a slight increase in the core PCE. That seems to be in the market for Treasury yields and significantly for dollar yen as well. Dollar yen is really having trouble getting above the 151 price. It was 2 weeks ago that it peaked in this cycle. It still hasn't made any new high ground. So not just if we get an inline number for PCE tonight, if it meets expectations, Treasury yields will probably pop a little bit lower, and dollar yen has a chance for a downside move as well, because people will be getting frustrated that it's lost the upward momentum. And of course, we keep on hearing from people like the Ministry of Finance's Kanda that they're getting concerned about the movements in dollar yen. They're watching with more urgency, which is often a signal they're getting close to some kind of intervention. Importantly as well, we also heard overnight from a number of Fed speakers, including the New York's Williams, who is closely watched, saying that he still supports 3 rate cuts in the dot plots this year. So that's a signal that we probably won't see a change in the dot plots in the March FOMC, which from the Treasury market point of view is a bullish signal, because there were some concerns that they may dial back and only talk about 2 rate cuts in the dot plots. That now looks as though they're going to keep repeating the same one as we saw in December, which is a net positive for the bond market. So overall, most of it's priced in, and things are skewed to slightly lower yields by the time all the data has settled later tonight.
Mark, thank you. Mark Cranfield there, MLS strategist on what to expect here across these markets. And one thing that we're watching very closely, of course, is turnover in this Bitcoin ETFs that we're seeing. Basically, this is what's lighting a match across the flows here right now. Turnover hitting a record as investors continue to chase these higher returns. We were just talking about 54,000 just a few days ago. We're now talking about, we're close to record highs of 69,000 as well, right? So obviously the first turbo of 60,000 since November 2021. We're now in the Asia session talking about $61,000 when it comes to Bitcoin. It's been nuts. Let's bring in our finance reporter, Sasha Goch. Sasha, we joked about this, that you would be coming back pretty soon. Here we are now talking about 61,000 for Bitcoin. Where to next?
Indeed, we did talk about it, and your words came true, Yuan. We are seeing a sharp short squeeze, if I can use that word, basically, which means that there is a gap between demand and supply in the Bitcoin market. We know that Bitcoin supply is fixed. Now, what is basically happening is, the exchange-traded funds in the U.S., which have been allowed to invest in spot Bitcoin, we're seeing a sharp demand from these ETFs in the US, and that's leading to a universal across the board demand for Bitcoin across the counter, across the countries, across the globe. So that's the reason we are seeing this kind of frenzy in the market where each day maybe the Bitcoin is rising by about 10% or so, and we have already seen the token double its price in the last 1 year in 2023, and this rally comes on top of that. That shows the kind of leveraged bets that are going on in the token. And of course, I have to also add that there is an upcoming event called Bitcoin halving, where the supply growth of Bitcoin is kind of is pulled back. That means that there is again another supply shock that could come on the token. So basically, it's like a aggregate factor of concerns that I will not get a Bitcoin. I'll not get to trade Bitcoin. A typical FOMO that we see in traders when a short squeeze happen, that's leading to the sharp rally in the Bitcoin market.
Okay. Yeah, so obviously the halving that's happening in April, there's a lot of kind of buying the rumor. I mean, how much impact could it have on prices? Does it have a lasting impact? Or is this going to be kind of buy the rumor, sell the fact once it does happen?
That's a very good question, Yvonne. Actually, it is something like what you actually you just said. It could be like lot of anticipation has gone into the expectation that prices will rise a lot more from here. If we are about 10% away from the record highs, so it might continue to go up until the halving happens. However, there could be some pullback. Number one, because as you said, the sell the news kind of an impact. But of course, the other part is there's a large leverage bet. The long positions have been built on leverage bets. That could unwind. The funding rates have gone up pretty much. So we have typically seen that when this kind of a bull run happens and leverages and funding rates go up, there is a kind of an unwinding of these that could lead to some correction in the market. But overall, traders are saying that given the demand being pretty strong from the ETFs, it might not be a very sharp correction, and also it not be a very long-lasting correction.
All right, Savashi. I'm sure we'll talk soon again. Sasha Goch, our Asia finance reporter, on this stunning Bitcoin rally. It's not just the Bitcoin. I mean, look at Ether and the like here. Cryptocurrencies are all sort of rallying pretty hard here this morning. We got plenty of big interviews coming up, including the CEO of Hong Kong Express. Of course, this is Cathay Pacific's low-cost carrier, on the outlook when it comes to travel demand, what Jeanette Mao thinks about these budget announcements about boosting tourism here in the city as well. She joins us as we wrap up our coverage of the Aviation Festival in Singapore. And we're also counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. Futures are pointing slightly lower here this morning. We'll see if we see a second day of the sell-off following some of these new quant rules that we're seeing here. This is Bloomberg Markets China Open.
Back in December, my colleagues and I put out what we call projections or forecasts, and the median was for 3 rate cuts this year in 2024. We're data dependent. We're going to watch the data. I'm going to watch the data. A sign of success to me is that, with inflation coming down and the economy so strong, that we can, be thinking about doing that, I would say, later this year.
Yes, there is always a risk of overdoing it at either end of monetary policy. This is why patience is critical. You're confident the economy and the monetary policy transmission is working as anticipated, then have patience. And that's what we were reflecting.
That was the New York Fed President John Williams discussing the policy outlook. Also, right there, Adrian Orr, our interview with the RBNZ governor, speaking earlier. That PBOC Fix just crossing your Bloomberg here this morning. Yep, no surprise, 710.36. So another strong support from the central bank here. We're talking about 721 for dollar offshore. So we're definitely watching very closely here some of the dollar gains that we've seen overnight as well. Let's bring in Wei-Liang, FX and credit strategist at DBS Bank, joining us from our Singapore studios. Wei-Liang, it's always great to have you. It's interesting. We've seen that PBOC Fix solid at 710 for some weeks now. What does that tell you about where the tolerance and risk tolerance is when it comes to dollar China?
Right, I think there's a lot of misunderstanding that just because the Chinese economy is not doing as well, there's obviously some disinflation pressures, there's excess capacity issues, but it does not mean that the RMB will be allowed to weaken dramatically. For now, policymakers are making it clear they think the RMB is perhaps quite undervalued. They're not willing to see the RMB undershoot too much. And at the same time, I think markets are also appearing a bit too pessimistic on China's growth outlook. So for us, we're seeing some signs that policymakers are stepping up in terms of the support they're delivering. Just in February alone, we have seen the RRR cut. We have seen the 5-year LPR reduced by 25 basis, and that's likely to support mortgage lending, support credit growth. And not only that, we have also seen very significant amount of support going into the LG/FV sectors. The market concerns have been revolving around credit issues in that sector because of a reduction in local government revenues. But given the fact that central government is dedicating more resources into that area, they're allowing local governments to actually raise money to repay LG/FV debt. We think that more or less stresses in this sector is going to dissipate over time. We think that obviously China is still in a bit of a stress scenario because of the transition away from real estate-led growth. But we think that given the strength in other sectors, especially in services, that the Chinese economy might be close to bottoming out. There could be a bit of a recovery going forward, and that would be helpful for the RMB. We think dollar RMB could perhaps ease towards the 7 level by Q3 of this year.
What needs to happen for dollar China to ease back to 7? I mean, is it really dependent on what the Fed does and when this rate cutting cycle begins?
Yeah, you're absolutely right. So markets have been swinging around in terms of the rate cut expectations for the Fed. Initially, we were close to 6 rate cuts for this year. Now we're back to 3. So I think in terms of expectations, we are close to being on the more hawkish side. If you just consider inflation, there has been somewhat surprising on the upside, but if you look at goods inflation, that has been trending lower, right? So it's only the services part and financial services that is providing a bit of a boost to services inflation. So we think that these are very idiosyncratic factors. More or less, we see the U.S. economy going into a soft landing kind of scenario. Inflation will slowly drift lower to its 2% target, and that will open up opportunity for the Fed to begin cutting rates. So we're looking at 2 rate cuts in Q3 and 2 more in Q4, and that's more likely the time when we see the dollar softening, and that's going to create a lot more boost, not just for dollar RMB, but also for the rest of Asian currencies as well.
Wait, I was going to ask you, some of your I guess, peers in the FX world, like Nomura's Craig Chan, he had a pretty interesting note that basically saying he thinks the yuan could actually face depreciation pressures, right? It's not just because, that window for near-term stimulus seems to be closing now, but you also have the risk of a U.S. election later on this year and a potential for a Trump presidency. Add on to that, he doesn't think those bond inflows into CGBs are going to be sustained for some time. How important are those sort of dragging forces for that dollar China right now?
I mean, China is always a punching bag for U.S. politics, right? So there's always a lot of concern what that means in terms of U.S. policy towards China. But I think China is approaching it from a more stoic point of view. They are prepared to work with whoever's in the White House, whether a Republican or Democrat. And we've seen in the past, in the Trump 1.0 administration, right? So China did work closely with that administration in terms of having high-level contact, in terms of negotiations around trade. So it's not necessarily the case that it's going to be a very adversarial scenario. There could be some politicking around trade, but we don't see it as a complete breakdown of relations. We see more. There's an equal likelihood of continued sustained cooperation and competition, obviously, in this space. And if you look at the geopolitical environment, sure, they have become a lot more complicated compared to the first, when Trump was back in power in 2017. But by and large, we have also seen China handling the situation fairly well. They have come up with more support for the domestic economy, even though FDI has fallen and bond inflows into China has actually been rather soft. So it is our view that... Yes, go ahead.
Yeah, I was going to get your take on credit, get your credit hat on. We've seen Asian credit actually outperform the U.S. so far this year, and it's really been led by the likes of China. I'm just wondering, what corner of the bond market do you like here right now?
So our 2024 call is for China credit to outperform U.S. credit on a relative basis. And, it's still the first 2 months of the year, but it seems that call has panned out quite well. We are looking more closely at the Hong Kong real estate sector-related credit. We think that potential upside opportunity. So obviously the Hong Kong budget yesterday provided a bit of a catalyst in terms of the removal of property market curbs, as well as reduction in several stamp duties. But also at the same time, we think that China's story is going to come strong.
Okay.
So that's going to be, I think, a big boost for China Hong Kong credit.
Right. Great. Wei-Liang, thank you so much for joining there. We're running out of time. FX and credit strategist at DBS Bank. We're checking Baidu shares down, some about 4% or so. Of course, after those earnings, we'll watch very closely here. This is Bloomberg. All right. We'll see if this continues, but southbound flows have been actually quite positive in terms of what we've been seeing. Mainland investors have been net buyers of Hong Kong stocks for 10 straight days now. So if that continues, we'll see if this rally can stick. But we're still talking about a pretty great February when it comes to Chinese equities. In fact, when you take a look at HSCEI, HSI, CSI 300, we are set for the best month in about 13 months since January 2023. So obviously this is a countdown to NBC. Have these state measures and what we're seeing across these quant funds. Is it enough to stabilize this market? We'll see. There were some wobbles yesterday, particularly when it came to some of these small caps of just these new rules when it comes to direct market access. So this is a very popular trading strategy among some of these quant funds. Does this mean that could deter some of these offshore investors away from this market even further? So your open is looking like this here right now. We're slightly to the downside here when it comes to CSI 300. We're lower by about a third of 1%. We're back below that 3,500 psychological level, 16,400 and change, and so for the Hang Seng. So we are seeing some declines. It is HS Tech that you can be as the culprit that's dragging things lower. Obviously, those Baidu earnings and the disappointment there, which our very own Robert Lee from BI did say may underwhelm again, given the fact that the weakness in this economy is really showing when it comes to advertising growth and the like here. We're not seeing a whole lot of movement when it comes to CGBs. CSI 2000, when the small caps, you're seeing continued erosion eroding here when it comes to the CSI 2000. We're down about close to 1%. We're down close to 7% just yesterday on the back of these new quant rules. We're seeing iron ore is slightly down lower here, so we could be talking about bear market territory for that commodity here as well. Keep in mind, crude, though, we are set for a second month of gains when it comes to Brent and WTI. We'll see how that plays out for Shanghai futures here this morning. But this is how we're breaking it down sector by sector. We're obviously going to watch the property space, just given what we heard yesterday when it comes to the Country Garden wind-up petition. You have the Hong Kong property and the budget, the support measures coming through. That we did see some gains, and really the clear winners out of this budget was the property sector. But right now it's a pretty mixed picture across the bag here. Financials are slightly up, but really we're watching those developers in China very closely as well. In terms of earnings, it's still big in terms of what we're expected. NetEase, Hong Kong Exchange, New World are set to report later on today. Baidu, there you go. We're down some 5.5% or more. Profit halving. It seems like the AI spending is really eroding the bottom line here right now. And Budweiser APAC as well. Those fourth quarter normalized net income did miss estimates. That stock is down some 6%. So still some weakness when it comes to the consumption, the tech space here today, except for crypto. Take a look at that, 61,265 for crypto. You talk about some of the record, inflows, turnover that we're seeing across some of these ETFs. It's just been nuts, and really defying kind of what we're seeing across asset classes, the correlations to the Fed and the macro picture here as well. Meitu, Huobi still doing pretty well here. Shenzhen Forum, Cintron Information, that's up 6% in Shenzhen. OSL Group, this is the old BC Tech, though. That's the one that's seeing a little bit of downside, but it's been basically up most of this week. And of course, the winners and losers of this Hong Kong budget we're watching very closely. So everything from your property developers, your New World developments. Okay, so they're still seeing some downside here today, but they did actually recover a bit yesterday. But they did trim some of those gains after we heard some of the quant funds and some of these rules here. Chow Tai Fook, the fact that they're bringing back the light shows, the fireworks, the drones every month. Is it enough to bring back tourists to the city? That's the big question here, especially when it comes to the luxury space. So I think in terms of the winners, it's the residents, it's the luxury, it's the property developers. We've mentioned S'more there. Some of the smoking tobacco taxes being raised, that certainly is going to be a loser there when it comes to this budget. So here we go. Here's what we heard, right? Basically nixing most of these property curves, cutting 15% tax on non-residents, suspending mortgage stress tests, and easing lending standards, just to be a little bit more simplified there. But right now, you're seeing your Hang Seng Property Index still lower this morning. We did hear from the HKMA CEO, Eddie Yue, as well, and he sees the easing of property measures will not affect financial stability. Take a listen.
The HKMA considers that there's room to relax the counter-cyclical macroprudential measures for property mortgage loans and to suitably adjust other related supervisory requirements, while continuing to maintain banking stability and ensuring the proper risk management of property lending by banks.
Let's bring in Hannah Jung, Head of Valuation Advisor Services at Colliers here in Hong Kong. She joins me here in the studio. Hannah, great to see you. So they're nixing all property curves. Was it warranted?
It's certain expect is quite surprised because we were debating whether some will relax, some will stay. Yeah. But it's quite surprised to see government scrap all of these measures. That shows how eagerness the government is to revive the residential market. I think transaction volume came down 40% compared to 2021. We used to have like 73,000 units transaction, but 2022 and 2003, we only have a 44,000 unit transactions. So that down by 40%. Mm-hmm. So that killed the whole ecosystem, developer, agency, like fit-out companies, interior companies. So that was one of the major driver to bring down the economy, not as good as what we expected. Mm-hmm. So government want to bring this volume back and scrap all these stamp duties.
Okay, so transaction volumes might surge. Do you have any numbers? Are you crunching on how much?
We are looking at around 63,000 units may transact this year. That's 5 years average from 2017 to 2021.
So what about prices then? Can I expect home prices to turn around in a positive way?
I think that will take some time. So home price, we still stay at the negative, minus 10% drop this year further, because there are still high interest rate and there are uncertain economy. So people want to hang on their cash. And thirdly, the competition between all these stocks. So there's 21,000 unsold units, and then government is pushing around 19,000 per year annually, putting new stocks on the market. And then second-hand market coming into the transaction area because they don't need to hold the 2 years anymore. They can sell without tax. So that will all bring up the competition in the market and make the price level going down. I think the biggest driver to bring up the price in the positive way should be the interest rate, how they play.
And so are these measures likely to impact the new home markets? I mean, new homes and the like, or do you think the secondary market is the one that's going to benefit from it the most?
I think more on the new home market because developer will take a benefit out of it. Newcomers to Hong Kong, they like to buy newer apartment than older apartment, so they will go for the newer. And developers were holding up quite some time that they cannot meet the price level, so they were not selling. These stocks will come to the market, and that will boost up the transaction.
The one thing that I thought was quite interesting and substantial was the removal of some of these restrictions on Chinese buyers. Right before, you had to have a permanent residence in order to purchase property here. That also has been removed now.
Correct.
Could we see a flood of Chinese money heading back to Hong Kong like they used to?
I think no doubt. Government two objective here: bring more talent, bring more money, right? So we have around 100,000 people arrive due to the special scheme of the top talent, and that they also bring their families members here. So that bring up the population to bring higher demand. That's government's goal. And then bring money, not necessarily from mainland Chinese only, but overall globally, they want to bring more money to Hong Kong. So that's meeting the policy scheme. So that's what government want to.
How attractive is the Hong Kong property market now to some of these Chinese buyers? Or are there other alternatives out there and around the world that they're looking at?
I think if we don't have a tax anymore, I think Hong Kong definitely should be the most attractive city. Any other cities, you have a capital gain tax, or you have a limited buy, you can only buy one, but we don't have that anymore. You can buy second homes, third home. So I think if we look at the global content, Hong Kong should be most attractive. And now the rental performance is pretty good.
Yeah.
So people can buy for investment purpose, and then they can recover their mortgage spending by rental income. So I think that bring up the market.
How should we expect rents to play out? I mean, rents have been doing quite well because the property market has been so kind of dire. Could that reverse now?
I think new people coming into market will continue to have the rental market first. So we still remain positive on the rental market. And government just mentioned yesterday that they will bring more people to Hong Kong, and that will help the rental market further.
What about the retail property space? I mean, if they're bringing back the fireworks, the drones, is it enough to lure really tourists to come back and shop and go to some of these malls and buy?
I think government need to be more creative. They talk about mega events. They say $100 million for next 3 years to bring more mega events, and then $1 billion to tourism board to bring more events to Hong Kong. Those are good. I remember my teenager kids, they going to concert every month. But we didn't have a Taylor Swift. We didn't have a mega event. We're still competing with the Singapore and Macau. We didn't have enough space to host those mega events. So I think government need to be more creative and bring authenticity, because all the retail shops, we heard about those cha chan teng, those nice cake shops, they're all closing down during the COVID. We lost that color of Hong Kong. So bring back those colors to each street of the area. They will bring back the tourism back. Now we are around 60% of the pre-COVID range in terms of tourism arrival, where Thailand and Japan, they're already up to 90%. So we still have a way to go.
Hannah, great to have you. Thank you so much for you breaking down this Hong Kong budget for us. Hannah Jung, Head of Valuation and Advisory Services at Colliers Hong Kong. I just want to flash some of these lines that we're just crossing your Bloomberg here when it comes to the BOJ. So we are hearing from Takataka-san. They're releasing a text from the board member in this speech here. So they're saying that the price target is finally coming into sight. That's according to Takata. And Japan is at a juncture for a shift in norm. They need to mull nimble, flexible response for an exit, and the worsening of BOJ's finances would not affect policies. So that certainly is quite interesting. It sounds like you're talking a little bit more about where inflation is, and it seems like I don't know how the market's interpreting this right now. We're still seeing some strength crossing through for the Japanese yen, still hovering on that 150 level though. But yes, at a juncture for a shift in norm. All right, coming up, we're going to be live from the Singapore at the Aviation Festival. Asia will be speaking with the Hong Kong Express CEO on the travel demand the budget carrier is seeing, even as costs rise. Also get Janet Mao's reaction to this Hong Kong budget. This is Bloomberg.
We'll make every effort to promote mega events and design in-depth thematic tours, enrich tourism resources, and provide more novel products and experiences to cater to visitors of all types and sources. This will help stimulate retail, consumption, catering, and transportation demand throughout Hong Kong. We will allocate additional funding totaling $1,095 million.
The Hong Kong Financial Secretary Paul Chan, they're revealing $140 million in new budget measures to boost the city's tourism sector. And this all coming at a time where the Aviation Festival Asia is into its second and last day in Singapore. Let's bring in Avril Hong there with our next guest. Avril.
Yeah, Yvonne, just hearing there from Paul Chan and the support for the Hong Kong tourism sector. What do airline executives think about this? Janet Mao is CEO of Hong Kong Express, or HK Express. So, Janet, 1 billion Hong Kong dollars of support for the tourism sector. How do you think this is going to help? To what extent? Because you get the sense that fireworks, drone shows, this is not going to cut it.
Firstly, I think as the Hong Kong-based carrier, we are so excited about this extra funding that from the Hong Kong government to boosting the tourism. And really, we want to show to the world that Hong Kong is back after the pandemic. And also, we want to welcome more of the tourists around the world coming to Hong Kong. So as Hong Kong's only low-cost carrier, we are excited to play this role as well in bring all the customers from the Asia, mostly from our network, coming to Hong Kong. I think it's important that for this extra funding to put into the area that increase the attractiveness of Hong Kong, about the tourism, about the beautiful scenery, and those big events for Hong Kong. So I'm very excited personally, and I have high confidence about more tourism and welcome more tourism traveling on us, flying on us, and coming to visit Hong Kong.
What else would you want to see, though? I mean, besides funding and support? I mean, I'm sorry to use this again, but there's this Taylor Swift gauge that we see, and the pop star is coming to Singapore. She's not going to Hong Kong. What is it going to take to bring back the allure of the city to pre-2019 levels?
I think there are a series of big events that Hong Kong government is planning already, and together with the tourism board and all the industry players, concert, arts, sports event, the Rugby 7, for example, upcoming in early April. These will bring the excitement of the city and to the world, demonstrate again that Hong Kong is back. I think besides these big events, also the infrastructure, how to encourage the airline to fly to more destinations. I mean, for us, we not only fly to those big cities, we also fly to those secondary, so-called secondary cities. I think these cities also have big potential because those people probably haven't visited Hong Kong before. So for those cities, there are huge potential for those travelers coming to visit Hong Kong and the first time to see Hong Kong.
Which secondary cities and Tier 2 cities are you looking at specifically for these fleet expansion plans?
Yeah, so currently we fly lots to Japan. Besides Osaka, Tokyo, we also fly those Takamatsu, Kagoshima, Fukuoka, Okinawa. And for Northeast Asia, Taiwan, Korea, Jeju, etc. So, but looking at potential other cities, we are expanding more more into the Southeast Asia, right? With the Belt and Road Initiative, Southeast Asia also play an important role. So from the Southeast Asia country, the Philippines, the Vietnam, and Thailand. And moreover, we are also looking at strengthening our presence in mainland China. So we recently announced that we will launch the Beijing-Daxing flight from mid of March. And this is not just a new destination, it has the symbolic meaning because it shows our confidence about the whole, China air demand, but also showing that our strategy in terms of network to have a more diversified and balanced network. As I said, we have almost 70% the network in Northeast Asia and 25% in Southeast Asia, and only 5%, we only have one destination in mainland China, Ningbo. So we want to build a more diversified, resilient, and balanced network with the new fleet, as you mentioned. There are lots of new aircraft to be delivered in the coming years.
Is it only just one route? Beijing obviously is one you've focused on. How many more are you likely to add, particularly in the mainland now, Janet?
So currently we only have one, Hong Kong Ningbo. As the first destination we announced this year is the Beijing-Daxing, but more will coming, definitely. Although the network for us in mainland China is not big, but I would emphasize that actually Greater Bay Area is a very significant, important market for us. Actually, 1 out of 4 passengers on HK Express are coming from the Greater Bay Area. So they are coming through the road or coming through the ferry or through the bridge, the Hong Kong Zhuhai-Macau bridge, and coming to Hong Kong and fly on us. So Greater Bay Area, we also see a big potential. Actually, since earlier last year, the passenger from Greater Bay Area on HK Express actually tripled. And we see a huge potential with the ease of the visa, relaxation between mainland China and many Southeast Asian countries. I think there is a huge potential for more Greater Bay Area passengers coming to Hong Kong and travel to those distinct destinations that we fly to.
Interesting. When it comes to Greater Bay Area, I'm just wondering when it comes to just overall the Chinese market, outbound tourism, outbound travel has been slow to pick up. In fact, we're not quite back to pre-pandemic levels here right now. And really what's hurt is some of the long haul sort of travel, which is not really your focus when you focus more on the short haul. How has Hong Kong Express been able to take advantage of that?
Definitely. I think that we focus on leisure and the short haul sector. And as you know, after pandemic, actually leisure traffic recovering faster than business, short haul traffic recovering faster than long haul. So we benefit from this short haul leisure segment, the faster speed of recovery. Last summer we see throughout the whole summer, 2 months, our average load factor is breaking the record is 98%. It's not surprising to see 1 or 2 flights or during a peak season about 98%, but it's a whole summer, 2 months. And we see that momentum kept the momentum until the Christmas and the New Year and the Chinese New Year. And from that, we also see a healthy and encouraging booking trend through the Easter and the upcoming summer. So I think definitely there is economy uncertainties and all these. But I think overall in the long run, we are still quite confident about the China market. If you look at how many population in China have, travel on air and even international, I think that there is still a relatively low ratio, and there are still a huge population have never flown on air. Right. And also in terms of frequency, right, compared to developed countries, the frequency of air travel for other developed countries are much more than China. So I think as the LCC, we low-cost carrier, we provide affordable fares and bring the travelers to fly. Definitely we have a role to play, and I believe we can capture on this opportunity.
Jeanette, thank you. Jeanette Mao there of Hong Kong Express, the CEO. Also, our thanks to April Hong. Really great coverage here all this week when it comes to the Singapore Air Show, also the Aviation Festival there in the Lion City. You can also get an insider's guide to the money and the people shaking up the Hong Kong city here in our new Hong Kong edition newsletter that's out every Thursday. You can sign up through our website, bloomberg.com/newsletters. This is Bloomberg. All right, you're checking markets here right now when it comes to some of the benchmarks. We are seeing Chinese markets slightly to the downside here today, but February has been pretty good when it comes to the HSI, CSI 300. They're set for the best month since January of 2023. The Nikkei 225 hit a record high, of course. And, of course, the S&P, that's the big one here, on track for a fourth month of gains. You look at when it comes to currencies and really what we've been seeing, that dollar strength really playing through when it comes to the yen and when it comes to the renminbi, right? So we're talking about a second straight month of weakness from both those currencies. Obviously, what we've been hearing for the BOJ, the support measures we've seen and the cuts, of course, in monetary policy that continues to weigh on the currency for dollar China. And Bitcoin, of course, that's still the best asset class out there. Best month since December 2020 for the cryptocurrency, and oil as well. Not too shabby, on track for a second month of gains as well. So overall, I think in terms of risk, it's looking like we can continue to see this risk rally continuing on in February. In terms of some stocks to watch, Budweiser, APAC, that's the one we're watching very much when it comes to, of course, the consumption space and the like. We're down some 3% for the stock, so sliding as we did see net income missing estimates there for the fourth quarter. We're also watching, of course, when it comes to some of these power stocks, CGM Power, Hygon, Infotech. That's going to be joining the FTSE China A50 index there. Hygon up close to 3%. And then we're watching, of course, Checker Markets coming up, where things are turning a little bit more positive across Greater China.